Good morning. I'm Wendy Edelberg, Director of the Hamilton Project at Brookings. Thank you for joining us today. With the many provisions of the Tax Cut and Jobs Act set to expire, the tax code will likely be the subject of intense debate over the course of the next year. Today, we'll be discussing part of the tax code that receives too little attention from policymakers: the tax treatment of partnerships. Partnership tax rules are notoriously complex and have critical weaknesses that generate wasteful planning, undermine equity, and reduce revenue. The Hamilton Project and the Tax Law Center have released a policy proposal today offering options to modernize partnership taxation in 2025. For today's event, we'll have a panel discussion with Miles Johnson from the Tax Law Center and an author of the proposal, Bill Gale from Brookings, Monisha Santamaria from KPMG, Dana Wollman from Cleary Gottlieb, and Lily Batchelder, who's also from NYU Law. Following their conversation, we will be able to take questions from you all. So please submit your questions by tweeting at Hamilton Proj and at Tax Law Center NYU with the hashtag partnership tax, or by emailing info@hamiltonproject.org. I would now like to welcome Chye-Ching.
Thanks so much, Wendy. Welcome, everybody. So the corporate tax rate and base gets lots of attention, as it should. But today there are actually more partnerships with their own special federal income tax rules than there are companies that face the corporate tax rate. In simple terms, the federal tax system doesn't see a partnership as a separate entity to be taxed. Instead, the partners are taxed directly on their share of the partnership's income and activities. So partnership income isn't subject to two layers of tax. So here's where partnerships are today in 4 charts. First, nearly a third of all US business income flows through partnerships, that teal slice. That's a big and has been a growing part of our economy and tax system. And that means whether they're taxed rationally is an issue with hundreds of billions of dollars at revenue potentially at stake. Now, most partnerships are very small, but this next slide shows that most of the economic action is among the tiny share of partnerships that control the lion's share of all partnership assets and income. So you can see here that the 2% of the largest partnerships, that rightmost bar, receive 2/3 of all partnership net income. And those partnerships tend to be in industries like finance, insurance, and real estate. Partnership income itself then flows overwhelmingly to high income filers. In this third slide, we see on the very leftmost bar that 68% of partnership income goes to filers with more than $1 million in adjusted gross income annually. And that's an even larger share than other common types of business income like dividends from corporations. And this final slide is an IRS illustration of the type of complex ownership structures that are increasingly seen among large partnerships. There were just 36 large complex partnerships in 2002, but by 2019, there were more than 6,000 of them. Partnership tax rules are also very flexible and complex compared to the tax rules for other types of business. And that can be a good thing. It means they can accommodate the complex economics of many modern businesses. But the downside is that they can facilitate complex structures that are engineered to avoid or even evade tax. The rules can make it hard for even the most diligent partnership tax experts to be fully confident that they're getting things right 100% of the time. So next, we're going to get into these questions of whether we need to modernize the way that we tax partnerships, and if so, how and why now. So to take us off into that discussion, I'm going to introduce the moderator of our panel discussion, Lily Batchelder. Professor Lily Batchelder is the Robert C. Koppel Family Professor of Law at NYU School of Law, and she's a faculty director of the Tax Law Center. Professor Batchelder was the Treasury Assistant Secretary of Tax Policy from 2021 until February 2024. And fittingly for this event hosted by the Hamilton Project, she received the department's highest honor, the Alexander Hamilton Award. So let me kick over to Lily, and I'll be excited to join the other panelists in this discussion of partnership tax modernization. Thanks, Lily.
Wonderful. Thank you, Chye-Ching. It's really a pleasure to moderate today's panel in discussing partnership tax reform as a key component of current and future tax debates. This is an area that many people believe needs work. Unfortunately, the discussion of problems and solutions has too often been limited to a small group of tax experts who specialize in partnerships and speak its technical language. But it's a really important area of the law that warrants genuine engagement from all of those of us who care about tax policy and the nation's fiscal health. So, as we'll hear today, partnership law has largely stayed the same since the 1950s, while obviously our economy has changed very substantially. And I can't imagine a better group to discuss this topic than the panel we have today. So we have Bill Gale, who is the R.J. and Frances Miller Chair of Federal Economic Policy and Senior Fellow in Economic Studies at the Brookings Institution, as well as co-director of the Urban Brookings Tax Policy Center. We have Miles Johnson, who is Senior Attorney Advisor at the NYU Tax Law Center and lead author of the policy proposal released today by the Hamilton Project and the Tax Law Center. Previously, he was a partner in the tax group of Kirkland and Ellis, so knows all the technical details very well, as does our next panelist, Monisha Santamaria, who is a principal in the Washington National Tax Pass-Throughs Group at KPMG. She previously served as a legislation counsel at the Joint Committee on Taxation. We also have Diana Wollman, who is senior counsel at Cleary Gottlieb and previously served as the Internal Revenue Service's first director of international strategy. And then we, of course, have Chye-Ching Huang, who is the executive director of the NYU Tax Law Center. And I should note that the panelists here are giving their own views, not those of any employer or other institution. So with that, I wanted to start with you, Miles. And could you talk a little bit about what you and your colleagues are trying to, oh boy, I think we might have just had Chairman Wyden join us.
Hello,
so we're excited about that.
Lily, Chye-Ching is the NBA All-Stars of tax.
Wonderful. We're so glad you could make it.
Sorry to be a little late. Look at all
No
these
worries.
people. Bill Gale, everybody. Diana. Good. All right. I'll try to be marginally coherent. We've been putting in some serious hours the last couple of days.
Thanks so much.
Well,
First Chye-Ching. Okay, great.
Yeah, terrific. Well, look, I know there are a lot of important things going on in the world, and we're just delighted to have you come and put a spotlight on an area where you've really pushed forward the discussion around something that we think is an important part of our tax system and economy, which is partnership taxation. Senator Wyden, the senior senator from Oregon and chair of the Senate Finance Committee, has in 2021 introduced a discussion draft of proposals to address loopholes used by pass-through entities and primarily focusing on partnerships. So that's a key touchstone for our conversation today. And Chairman Wyden, let me just kick off by asking you, why take this on? The tax law governing partnerships has been around mostly for longer than the federal highway system. It's had fewer repairs. Why take on this challenge?
Well, I think you almost answered your very good question. If you haven't done anything on stuff that has changed so dramatically over the years, you're not doing your job as a public servant. And it just seems to me that, the focus has generally been on the corporate rate and the top marginal rate. And we just kind of continue to chew on those kinds of things. And we're not really looking at the really serious tax dodging that goes on. And these large partnerships are a very important example of that. I mean, the partnerships are basically defined by the big guys who pull in the vast majority of the revenue. And the rules are an incredible nightmare for the small business folks. And what happens is, as you all know, because you've been in these precincts for a long time, is the big guys just go out and hire loads of people. And they've got these armies of lawyers and accountants, and they can winnow down their tax bills. And the reality is, this is all unbelievably dense and complicated stuff. And the ball game is about shifting debt around and dodging taxes and all these exotic schemes. And the big guys go out and hire the very best talent there is. And the little guys don't even have the money to get started. And that's why we're taking it on.
Excellent. And, you know, I guess a follow-up to that is why now? 2025 is going to be a pretty complicated and big year for tax policy. And why do you think it's ripe for this discussion?
Well, I mean, we've made it clear that our priority as part of this 2025 debate is about addressing the loopholes that are particularly serious and bringing some common sense into this discussion. And these ultra wealthy people who, I mean, normally you think about, you know, a partnership and a small business. It used to be, you know, the gym store, you know, that would sell, you know, some gym pants and gym clothes, and people pay taxes as individuals and go about their business. That's not what this is all about. And, you know, we're talking about, you know, wealthy people who are going to use partnerships in a way that the average person isn't. And I want to make sure we do this, we do it right, in particular to make sure that we protect small businesses. And I've talked to a number of my colleagues about the importance as we go into this. And this is what I'll be looking at in the kind of proposal we're talking to members, is making sure that we're being sensitive to small businesses.
And, you know, I think a potentially particularly interesting thing about partnerships in this 2025 context is, as you know, it's, you know, even though nothing has been done, there's been a long bipartisan history of some attention on this. And in fact, some pretty far-reaching ideas from the likes of Chairman Camp and the former Bush Treasury, looking at really, you know, either repealing or very much restricting Subchapter K. So some of the proposals that I think you've been pushing forward are even more targeted and potentially have some appeal from that perspective too.
I think that's right. In 2025, it's obviously going to be a complicated, you know, time. We've already made it clear that we're staking out some important ground. You know, for example, the $400,000 provisions, we're going to make sure we protect those with incomes under $400,000. That includes small businesses. That almost starts the discussion about how you're going to treat partnerships. And I just feel very strongly that if we're going to have this big debate, we look at serious issues that are really driving activity in the private sector around tax avoidance. And I think it'd be legislative malpractice to just punt on this issue. And I think we can do better on that. And we have made it clear that we're going to focus on trying to clean up the mess in the tax code in the most serious areas, and large partnerships strike me as one of those.
I think your mention of avoidance is pretty important, because there is a difference between lawful tax avoidance and unlawful tax evasion, but we know that in some of the most complicated areas of the law, that line can get pretty blurry. And you've previously really shone a spotlight on the idea that the IRS has not had capacity to really crack down on non-compliance involving partnerships. Can you say a little more about what here is, you know, what's needed here, and whether sort of both legislative change and funding can help on that?
I think it's important to talk about the IRS, you know, role, because, I mean, you know, the Republicans basically want to turn the agency in a place with, you know, a handful of people and zero technology. And, you know, the reality is, if you're one of these big partnerships now that's raking in, you know, huge profits, you're more likely to get hit by lightning than to face, you know, an audit. And That's another way in which the ultra wealthy benefit from the complexity, and they're going to have a chance to say, hey, we can take advantage of these loopholes in tax dodging if you don't have a strong role for IRS enforcement to ensure that the rules apply to everybody. Tax dodging essentially becomes part of the business model where there's no reason to believe you're ever going to face any consequences. And from the IRS's perspective, it takes time and resources to ramp up enforcement, and that's particularly true when you're taking on these kinds of businesses.
Yeah, I think that's exactly right, and I think the panel will discuss later as well this issue of not just needing to ramp up the number of audits, but really increase the quality. As we've sort of seen in the past, that even where there are audits, a lot of them result in no changes, which indicates they're both being not well targeted and potentially missing some things.
And if the Republicans are able, and this is almost their kind of playbook, to gut the agency's enforcement budget, and then they can gut the ability to have any kind of tax enforcement at the top for those who have the most resources and the most experts. What you're going to do is have a system that falls disproportionately on small businesses and typical families and those who claim the earned income tax credit, the child tax credit. And what you're going to have is a situation where the Republicans keep saying, well, they're not getting very much done. And then they can have another argument for gutting the IRS enforcement budget even more in the future.
So I think, and that just sort of really returns to a point that you started off with, which is that one of the often levied objections to reforming partnership taxation is that it would hurt small businesses and compliant filers. But I think you've pointed out the ways in which that is inaccurate in some senses. Is there anything you wanted to add to that issue, given that it will be such a core question?
Well, the reason we're going to be very careful is I keep telling everybody in the office, and we all, talk about it. Let's think about this in terms of the family-owned auto shop. Now, they often aren't structured in a way that's going to allow a whole lot of basis shifting. That stuff doesn't happen by accident. It costs a lot of money to hire people who can take advantage of those loopholes, and they're dodging millions and millions of dollars in taxes. So we're going to kind of keep as a lodestar those small family-owned businesses and make sure that as we try to work through this issue, which you're absolutely right to say, hey, people didn't take it on in the past because it was complicated. I just think it's legislative malpractice to say you're going to pass on this when the tax avoidance is so serious. And I think that we can come up with a way to say that we can be fair to all sides and work through, for example, those small family-owned businesses, the auto body shop or similar ones, while we're at the same time being fair to everybody who is under compliance challenges as they go forward in the future.
Thanks so much, Chairman. We're going to have a panel next that really digs into, tries to demystify some of this complexity and sort of really put a finger on what could change. Is there anything else that we should be thinking about and talking about as we do that?
I can only say that I'm really looking forward to the scholarship that you're doing. I know you guys are looking at these issues and going to do a paper. And this is, I often call these kinds of issues the sort of areas that are like root canal work in the tax field, but they're incredibly important because these rules weren't written in stone years ago to just be ignored for the future. And it's time for bringing them in line with the times. And I think it's possible to be sensitive to the needs of small business and to make sure that people are treated fairly.
Well, that's given us a lot to talk and think about. Thank you so much for your remarks today, Chairman, and for joining us and teeing up this terrific conversation.
a kind of foundation from our end, but I know you're going to do some serious scholarship here and look forward to seeing your comments.
Thanks so much.
Big thanks.
And thanks everybody for accommodating our shift in schedule as we made sure that we got that terrific input. Lily, back over to you.
Great. Well, I think we had just finished making our way through introductions from our illustrious panel. And so why don't we turn to digging into the paper? And Miles, I was wondering if you and your colleagues could talk about what you're trying to achieve with this paper.
Yeah, definitely. And thanks so much, Lily, and thanks, Chye-Ching. So our main goal with the paper really is to highlight partnership tax reform as a needed and key important part of this upcoming 2025 debate that we're all preparing for, that's coming down the pike. And as you said, so I worked in private practice for a while, nearly a decade at a large law firm before coming over to the Tax Law Center, mostly on complicated transactions, many of which and maybe even most of which involved partnerships. And so I saw a lot of it. And you have, technical partnership focused folks out there like me who have been making this point that partnership tax rules are in need of some updates, whatever those look like. And 2025 is a good time for it. But at the same time, as we heard a little bit about, right, partnership tax still seems to be a bit of this technical corner of the code that gets lost or overlooked in these bigger policy debates. But the reality is that now partnerships are everywhere and they look and feel a lot different than they used to back when a lot of these core rules were written. But then, the upshot is that the rules haven't gotten focus outside of this sort of corner of technical experts. And so with the paper, what we want to do is bring those rules into the 2025 discussion early in the process in a detailed and technical but still understandable way so that people can follow these issues, get their heads around them, and think about the right ways to fix them instead of having partnership stuff come up too late in the whirlwind of the 2025 process, or just get lost in the shuffle of the broader negotiation as it has in the past.
Great. So Bill, can you sort of set the scene for us heading into 2025? What is the fiscal context? Do we need more revenue?
What a scene it is. To start out with, we've got long-term deficits where there's pretty much universal agreement now that long-term fiscal outlook is a problem, whereas 5 years ago, a lot of people were saying, we don't really need to worry about that much. But the long-term fiscal outlook demonstrates a need to raise revenues. Second, of course, we've got the individual income tax provisions expiring in 2025 for the Tax Cuts and Jobs Act. In particular, for partnerships, that affects the top rate, the 199A deduction for pass-throughs, and the state and local deduction, where a number of businesses have created workarounds and stuff like that. So basically, a lot of provisions of the tax code are going to be in play next year, and certainly those that affect partnership taxation are long overdue. The third thing I'd highlight is the long-term evolution of the distribution of income toward higher income households and toward capital income away from labor. And at the same time, we've seen lower taxation of capital income and relatively higher taxation of labor. So partnership income flows disproportionately to the top 1%. So it's front and center in those income distribution debates. And the last thing, of course, I mentioned in the context of fiscal policy is tax evasion, which is quite large. And as we just heard, could be affected by IRS funding. And a lot of the action there is probably in partnerships. I mean, I laughed out loud when I saw that ownership structure that Chye-Ching put up. And so all four of those themes, fiscal policy, TCJA, income distribution, and evasion, all intersect heavily with partnership taxation.
really helpful. And you referenced some of the data and research on partnerships, but I was wondering if you could maybe mention a few more things that might be striking to people who are new to this space about partnerships.
Sure. Pass-throughs used to be sort of a sideshow. There were corporate taxes and individuals that worked and stuff like that. And there were a few sole proprietorships and stuff like that, and some small partnerships. Partnerships are now enormous. They've grown dramatically since the Tax Reform Act of 1986 changed rules. We now have some enormous partnerships in finance and real estate. There are many small partnerships, but the enormous partnerships that Senator Wyden was talking about that are dominating the avoidance and evasion discussions are huge. And of course, you can't ignore the fact that the vast preponderance of income is going to the top 1% of households. All of those facts come out very strongly in the paper, and then the opaque ownership structure again, which is just an invitation to avoidance and evasion, comes out strongly. I just mentioned one thing. There was a Treasury study using IRS data several years ago with something like 10 co-authors digging into the data. They could not trace the source of the income of 20% of partnership income. That should send off alarm bells to anyone who's concerned about equity, avoidance of evasion, and so on.
Was really striking to me too, that no matter how much they dug, they just couldn't find out where that income was with all of the resources of the IRS, as well as those charts that we've been referencing of what complex partnerships look like, which are so different from, I think, what some of us originally might have thought partnerships to be. So Monisha, following on that, from your perspective, what do you think are the key things that people, both policymakers and taxpayers, should understand about the prospect of partnership tax reform, given what Miles and Bill have already outlined?
Let me unmute myself first, and I'll thank the Hamilton Project for hosting this, and Lily and my fellow panelists for what will be a very fun and hopefully illuminating discussion for everyone today. Miles points out that the core partnership tax rules were written decades ago, and I have to agree. The framework of Subchapter K was written in the 1950s, and the 1980s were the last time there were substantial but probably not fundamental changes to the Subchapter K or partnership tax rules. However, I do think discussions of reforming partnership tax rules have existed for decades, and those discussions have included many suggestions from those inside and outside the partnership tax bar. So some history, or my version of history. Commentators, especially outside the technical corner, have long spoken about throwing Subchapter K, and this is a quote, on the funeral pyre. It's in an old academic paper, and I think the quote's really, really good to think about. It just means that people get frustrated while looking at the rules without understanding all the complexities and the need for some of these rules. So for decades, at least in my view, there's been talk of eliminating Subchapter K or the partnership tax rules by combining its rules with the rules for S corporations or creating a unified pass-through regimes. And others have simply talked about creating something radically different. But, and this is what I think is the key point that I hope everybody leaves with today, those clamoring for the head of Subchapter K should recognize that changing Subchapter K so it's just simpler, or looks more like Sub C is not a reasonable option because of two things that have to be true in the world. First, economic arrangements where risks and rewards and efforts aren't shared equally have existed and will continue to exist no matter what the tax law says. You can go back in history to the time of the Romans. For example, Cicero wrote about an arrangement that looked and smelled like a partnership, and it was found in an old boat. So like these things have existed and they will continue to exist, and we want them to exist. You can think about your neighborhood Italian restaurant. Let's say two siblings inherit a restaurant. One loves to cook and wants to run the restaurant. The other wants to go travel the world. It is just fair that the person in the kitchen gets more of the profits. I don't think anybody's going to disagree with that. And while we don't need all of subchapter K for that, you know, there are arrangements that are a bit more complicated where we need many aspects of subchapter K. So given the fact that we have non-pro rata arrangements, and they're a good thing, there's a need for rules that tax this economic activity in a way that's logical, because it's fair and because creating different rules where you divorce economics and tax is just bad for everyone. You can say that rules that divorce economics and tax allow for a game of whack-a-mole where taxpayers plan in the existing rules, which is sort of what the Supreme Court said they could do many decades ago, and then the government's forced to play a game of whack-a-mole, and a game of whack-a-mole just doesn't work well. So those who just want to throw it away, not a reasonable option. And I think there are lessons from history that say that those who think they want to throw away and study it long enough realize it's not a reasonable option. I have a story from the Joint Committee on Taxation. In 1999, prior to joining the Joint Committee of Taxation, George Chin, who then joined as the Chief of Staff, wrote a paper saying, let's get rid of pass-through tax, or let's create a single regime with different rules for small entities. So when he got to the JCT, I think the staff spent more than a few years trying to make this work. There was a JCT report later noting the significant policy issues, and that's a quote, with their approach. And it said, and I think the lesson from history is like, it sounds good, but it doesn't really work to just simplify without creating rules that allow for the economic flexibility, which is different than optionality that lies behind the partnership tax rules. And the need to align tax and economics is what makes partnerships tax so hard to understand, and it also makes it so hard to reform. That doesn't mean that we need to just give up any reform efforts. It just means that we need to make sure any ideas continue prioritizing aligning tax and economics in a way that is not too complicated, and then making changes within the existing framework makes sense. So moderate, measured changes within today's sub K makes sense, and that's the point I would love to make to policymakers.
Thanks, Monisha. That's really helpful. And I think maybe it makes sense to go back to Miles. Miles, how did you and your colleagues at the Tax Law Center choose the proposals you focused on in a paper? Monisha's arguing, don't throw out subchapter K, maybe preserve the partnership that Cicero had. How did you think of what to keep and what not to keep?
Yeah, totally. So I think it is a lot of what Monisha's saying. So, as we've heard a number of times already in this event, and I think people will continue to note, which is our starting premise, which is that the partnership tax rules were largely written in and designed for a world that looks a lot different than the one we have today. And there are you can find examples of this. If you look through the legislative history back in 1954 for the original, the current sub K rules that we have today, you can find statements sort of suggesting, for example, that the partnership rules don't really need to worry so much about partners shifting gains or losses between each other, because that's a matter for between the partners. They can work that out, and from Treasury's perspective, somebody's going to pay that tax. But you can sort of see how that built into that logic is the assumption of a pretty simple case, a partnership among essentially unrelated US taxpayers, each with their own interests and each that's actually subject to tax. But that sort of, simple case, it matches a lot of partnerships today, but it doesn't match many of them, which are typically, and often these days, super complicated arrangements, often between lots of different parties, including parties that are related or that just have totally different tax profiles, or that are internal arrangements within a single organization. And all that means that, in today's world, the shifting between partners does actually matter, and partners are gonna look for ways in line with that case that Monisha mentioned to shift those gains and losses between each other in a way that reduces their taxes. And that's a real issue for the tax system, and that Treasury and lawmakers should care about and think about. And so that was our starting premise for choosing the proposals. And from there, bringing it back to some of the points Monisha made, we sought to choose a specific list of proposals that would largely be aimed at modernizing the existing partnership rules, both by getting at specific known potential abuses, as well as just gray areas in the law that might exist where people can just kind of push the limits. And we wanted to create a specific list of proposals that would include both bigger and smaller reforms. So we do talk about in the paper some of those bigger reforms Monisha was alluding to, but we also wanted to include smaller ones within the framework of current rules. So, we tried to lay this out from just more simple legislative cleanup type edits to the bigger and more complex options, both within and outside of subchapter K. And then, in picking those proposals, we also wanted to focus largely on options, and the paper does focus largely on options that do, I think, retain those aspects and goals and aspirations of partnership tax law that do make sense, such as the ability to arrange varied economic deals and have your tax results follow those economics. I think that's a core, if not the core goal and principle behind the partnership tax rules. But we also wanted to sort of, in light of that context, people have gone through already, find proposals that do cut back on features that just don't make sense any longer in the current environment. Things like optionality that just isn't really needed anymore, that seems outdated, or that, as time has passed, we've learned just kind of serves to incentivize planning opportunities. There are a couple other factors, I think, that policymakers will need to consider as partnership tax reform makes its way into the 2025 debate, which are, ease of enactment of any given proposal, and its revenue impact. And so I think where that leads you is that reforms that are targeted at, that are specific and targeted at kind of known issues in the existing rules, but also that have the benefit of raising real dollars, are going to be the types of reforms that are worth prioritizing and, get the most backing. And our hope is that the proposals we've chosen, in choosing our proposals, we tried to pick ones that and categorize them in a way that will help the lawmakers in kind of making those determinations. And then the last thing I'll say on kind of how we got to where we did is, as Monisha's already gone through, a lot of these specific proposals we've picked out aren't new, right? That, several of them have been around for a number of years. And so we sought to choose proposals from that context with 2020, upcoming 2025 in mind, but that's how we got there.
Yeah, that's really helpful. And I will say, having worked on the Hill also, it is comforting when a proposal is not new, because then that it's been out there, people have pointed out flaws, and made sure you haven't sort of missed some big issue in it, in what is a kind of technical area of the law.
Yeah.
So I wanted to pick up on that. And my sense is some people, maybe this is true of tax in general, but particularly partnership tax, think, oh, that's really complicated, I'm not going to understand it. That may be part of why we haven't seen real reforms in so long. Could you give folks listening a sense of both order of magnitude of revenue that might be involved in some of the proposals that you put forth, maybe just combining them, that are small, medium proposals that don't throw out subchapter K, but do align tax with economics? And then maybe give an example of a problem in partnership tax, whether it's abuses or rules that don't work anymore, and how the paper suggests addressing it in a way that, maybe my mom could understand, who likes to try to understand what I do, but is not a tax expert. So.
Yeah, definitely. So, on the magnitude, I think that's a key point, but the thing that I keep coming back to, based on just my experience in the world of partnerships before coming to the Tax Law Center, and from talking to people in the know, is that, you know, there's real money in a lot of these refinements, even things that aren't throw out the baby, you know, don't rise to the level of throw out the baby with the bathwater, and make everyone a C Corp or something like that. There are still, I think, real revenue impacts to, and we've seen some of these numbers quoted publicly already. Obviously, a couple months ago, we got a guidance package on related party basis shifting, and people are thinking about that and talking about that. But, you know, the number that was initially attached to that was, I think, 50 billion. And, you know, I think people are refining that. And so, you know, that's one example of, you know, something that's aimed at a specific issue, but that has been, you know, there are real dollars there. And I think that a number of these proposals are like that. You know, there are, you know, there's real money there. And there's some that are,
Talking
I
like
think,
hundreds of billions or
yeah,
not
I
single
think, I think many of
Okay.
them could be in the tens, certainly, and some of them in the hundreds. And so that'll, you know, that'll continue to be refined. But yeah, I think there's a lot of revenue. And as Bill said, we need it. And so I think that's another reason this will be a key focus. But yeah, so on the examples, a couple examples, I think this is good. And my colleagues can tell you we've had some practice in the past several months going through examples in a way that not only a non-tax person, but a non-partnership tax person can follow. And it's hard to do that. So anyway, so I think we can go through a couple in very simple terms that are easy to follow. So the first example of a key issue that I think is really easy for people to get their heads around is the issues that can arise in partnerships when you have related party partners. And this is a hot topic right now. But the key, you know, issue here is that the partnership tax rules, for some of the reasons Monisha's already gone through, allow for a lot of flexibility in terms of allocating the partnership's tax results between the partners. And that works reasonably well when unrelated partners are involved and own the partnership, because they're each going to look out for their own separate interests in negotiating that agreement. So what do we mean in this context by related versus unrelated partners to start off with? We don't offer a strict definition of relatedness in the paper, but one example might be, a key example, I think, is two partners in a partnership that are entities, but they have the same owner. And those two entities, because they have the same owner and they're kind of part of the same economic unit, their economic interests overlap. And so they're not necessarily truly negotiating at arm's length with each other when they negotiate the partnership agreement. In the case of unrelated parties that form a partnership, they're obviously going into business together. There's cooperation there, but because they're not related, they're still going to be separate economic actors, and they're each looking to make their own money out of the arrangement and protect their own financial position ultimately. And so, to put in super simplified terms, if you have two doctors that form a small medical practice as a partnership, you're not going to find a situation where one of them is going to agree to forego its entire share of the partnership income for some period of time to the other partner in order to lower the overall taxes paid between the two of them. And it's not clear the other partner would even want that in this case, which is to say their individual economic interests in that situation trump that sort of planning that is aimed at the aggregate tax benefit between them. But when you have related parties where their separate economic interests overlap, like the two entities with the same owner that I talked about a minute ago, you can see how it's much easier for one partner to agree to do something that looks economically bad for it in order to lower the overall tax bill paid between the two of them. And of course, because of the relatedness, that economic detriment that one agrees to is often not really real, but the tax benefit they can get from it is real. And so the simple paradigm, you know, example people say in situations like this is, it's like if I moved money from my right pocket to my left pocket and I got a tax deduction for it, right? At the end of that, I still have the money's mine, but my tax bill ends up lower. That's obviously super simplified. Hopefully your mom could follow it, and I've done my job, but there are more complicated kind of real world ways those sorts of arrangements and planning occur. And so a lot of people, including Senator Wyden, have highlighted this issue. And in the paper, we include a proposal. We discuss a proposal which also appears in Senator Wyden's bill that essentially requires the related partners in this example to share the partnership income and loss proportionately, rather than having this flex to, negotiate and generate tax savings out of the arrangement. I can go through another one real quick that I think is also similarly, can be easy to follow, but totally different, which is the worthlessness deduction for partnership interests. And a number of people have written about this recently. A nice thing about this example, I think, is that the legislative fix is very simple and essentially cleans up what I think is an incorrect policy result, where you have essentially similar transactions being taxed differently, which generally is just a bad tax policy, partnerships or not. So without getting super into the weeds, this example is, let's say you own a stake in a partnership and the partnership business goes downhill and just becomes totally worthless. It just tanks. Under current tax rules and with the right facts, you can potentially get a much better tax result in the form of a big immediate tax deduction if you simply opt to declare your partnership interest worthless, but technically hold on to it, versus if you were to sell it for nothing or for pennies or whatever minimal amount it's now worth, which should be zero. There's not really any good tax policy reason to treat those two things differently. If you're affirmatively saying the interest is worthless and that is your mechanism to claim that loss for tax purposes, it's not clear why you should get a tax break versus if you sell it or throw it out or get rid of it as your mechanism to claim that loss. They're kind of economically the same transaction. So in the paper, we highlight a pretty simple fix, which others have also highlighted, back to the theme of, these aren't necessarily new, which is to clarify that declaration that your partnership interest is worthless and that taking the deduction event is treated in the same way as if you sold your partnership interest for nothing or just disposed of it. And treating those two the same eliminates that mismatch, which, having the mismatch can generate planning, abusive planning opportunities, and ultimately taxes transactions in the same way when they have the same economic effect, which again, I think is a core goal. So that was sort of long, but those are two pretty well-known, I think, simplified examples that we go through in the paper, including the proposals that would address them. And, we also go through a number of suggestions about how to refine various proposals and things like that. But I think those are, easy examples for people to get their heads around.
Yeah, that's really helpful. And I'm sort of struck when you kept talking about related partners and parties. And I think the image that may come to mind is, the brothers owning an Italian restaurant on the corner, but you're talking about entities. These aren't people. They're large businesses that are owned by the same people that are related parties. And it was interesting how you were talking about them just shifting a coin, or maybe many millions of coins of deductions from one pocket to the other. It reminded me of a very long time ago when I was in private practice. We had a client who had just one of those insane spider webs, and it was one person, but as their attorneys, we could not figure out how all of these entities related to each other and what owned what and in what proportion, which is just crazy when you're actually their advisor and you can't figure it out. And then imagine the IRS trying to do so. Yeah. So Monisha, you worked on the Hill for the Joint Committee on Taxation. You're now in private practice. There are a number of proposals that are set out in the paper. And do you have a sense of what kind of proposals are more likely to succeed on the Hill while still addressing some of the gaming that Miles was talking about, or fixing gray areas that are in need of reform?
I will first point out that my crystal ball is very, very faulty. It keeps on misfiring. I'm not sure why. But I can talk about what's more likely to get on the menu that gets drawn up for the 2025 tax debate and stay on the menu. Also, that crystal ball could be faulty, but at least I can guess. So I think Miles hits on a number of really good points. I think the fact he's focused on proposals that leave in place flexibility for third-party deals is really key and important, and it creates proposals that can be a package that is more a win-win for all. For the first proposal Miles talked about, which is the related party pro rata allocation proposal. It doesn't impact unrelated
Chye,
parties.
could you move a little closer to the microphone? It's just
Is
fading
this
in and out.
better?
That'd be great. Yeah,
Can you guys
that's
hear
great.
me now? Sorry,
Yeah.
what's the mic issues? So I think Miles hits on some of the key, laid out two proposals that leave in place economic flexibility when two third parties enter a deal. The first proposal is only between related parties and is set forth in Wyden's discussion draft. It only impacts corporate related parties. So, the two brothers opening with a pizza shop, or the two two brothers who are doctors, do not get impacted by the proposal. It also ties into the $400,000 pledge that Senator Wyden spoke about when he was on about 45 minutes ago. So I think, leaving in place desired third-party economic flexibility is an important attribute of something that is more likely to succeed. The second proposal Miles talked about the worthlessness change that was in Build Back Better, also doesn't prevent third parties from going out and doing what they would normally do. Based on my private practice experiences, and it will align with everybody else's. Nobody enters an economic deal expecting it to go belly up. That's just not the way the world works. So nobody's going to, plan into needing a worthlessness deduction or loss. So I think having those types of proposals out there really helps. I do think that proposals within the existing framework are more likely to succeed from a revenue perspective. It is easier to score a proposal when you're not worried about a lot of unknown unknowns. And I think that helps. Like, if you create something drastically new, there could be benefits to taxpayers, there could be detriments, and there's just, this what if type of analysis that has to go on when scoring one of those. And I finally do think your point about things that already exist and have been out in public, so taxpayers can point out any flaws, or that does help. I think drafted language is actually one of the most important things that influences the possibility that something is put on the menu and gets over the line. And there's a lot out there in the partnership space. While there hasn't been much change to the partnership tax rules in a long time, there have been plenty of proposals changing the existing framework of Subchapter K. Camp put out many of those in around 2015. Senator Wyden has put out many. Build Back Better has a few. And taxpayers and tax advisors and policymakers should go forth and read. I think it's really, really important for taxpayers and tax advisors to carefully read and point out anything that doesn't work or could be improved, both from a policy or a technical aspect. This is a conversation that policymakers, taxpayers, think tanks, and everybody should be having right now. And that's going to make it a lot better. I think there's a way to make this a win-win situation, and talking and looking is the way to start.
Great. So I want to slightly shift gears. We've been talking about legislative proposals and changing the substance of the rules. Diana, turning to the administrative side, you've worked at the IRS, and I think that gave you a view into the challenges that both taxpayers and the IRS face in following and administering partnership tax rules. There's one statistic in the paper that the rate of audits where the IRS asserts no change has historically been much higher in audits of partnerships than in audits of corporations. And I'm wondering if you can talk some about your key takeaways on why the IRS has historically struggled in this space. And I should note, it sounds like based on the IRA funding, they are investing more resources in this space, but would like to get a sense from you of, has it been a resource issue? Has it also been other issues as well?
Thank you. Well, I think a lot of the things that I've experienced when I was at the IRS have been raised, and that has to do with information, and both information and the complexity of the law. And the thing that I really became most aware of when I was at the IRS was how those things always benefit the taxpayer. Because an IRS agent starts out with your return, and that's all they have. And all of these positions that we've been talking about, they don't announce themselves on the return. They don't say, look, I took this position. Sometimes it's just a deduction or just the lack of an item that doesn't appear. So how is an auditor to even know where to look and what questions to ask? And the auditor can only ask questions. An auditor they can't ask a question like, what aggressive position did you take? What positions did you take that you ran your hands over? They can only ask for specific backup for what's on the return. And then the other thing is that you think about some of the examples that that Miles and Bill Gale talked about. You need to understand all of the different partners. So you're auditing the partnership, or you're auditing one of the partners, but you can't tell that there's something funny going on unless you see the full picture. So how do you see the full picture if the audit is of the partnership or one partner or the other partner? And then, you know, Bill talked about the inability to trace the source of income. Well, that's not going to change when the auditor's there asking questions. And so you might need to know more about the partners going across, but you might need to know more about all the tiers going up and down. And it might not be that you can see why some allocation at the lower level is contributing to what someone in full understanding of the law might consider aggressive or might consider wrong, unless you understand all of that. And the thing that really struck me is the IRS, they're not going to assert an underpayment unless they have a really good basis for doing so. This isn't like an M&A deal where you can smoke out information by just asserting something. So a no change may result simply from the IRS not ever being able to find enough information to back up something that they aren't sure about. And then the aren't sure about is the last issue, which is that I would assert that the partnership law is not just more complex, but there's more uncertainty about what is appropriate and inappropriate. And that faced with that uncertainty for the reasons I've been explaining is always going to benefit the taxpayer, which I think may explain in part, in addition to the fact issues, the lower change rate with partnerships.
Really interesting. So it sounds like in that spider web chart that we keep talking about that's in the paper, often the IRS just sees one little dot in the spider web, and they need to know the spider web because that can help them understand whether there are abuses going on. And then even if they are, you know, well over 50% confident that there is, they need to really have all of the documentation that they don't have access to verify that there is an abuse. And that's another resource and information issue. And I noticed some of the paper includes information reporting as well. This raises another question for me of there was a significant overhaul of the rules that govern auditing of partnerships that went into effect in 2018, the Bipartisan Budget Act. So maybe it's a question for you, Miles, or Diana or Monisha, but have those rules meaningfully improved the IRS's ability to audit partnerships? Are they too new, or what did they do?
Yeah, I'm happy to start. So I'll touch on the BBA point first, but I a couple follow-up points also on I think the very good points Diana was making. But with respect to the BBA, so I think the answer about, you know, have those meaningfully improved the issues we're talking about here. I think going to those gray areas, the answer is essentially, in my mind, kind of yes and no. I think a key point is that those rules changed things on the procedural side more so. So they changed the procedures for auditing partnerships and collecting tax owed, but they didn't necessarily make it substantively easier for the IRS to find and assert issues when auditing the returns, which is kind of the stuff Diana was talking about. And so at a super high level, before BBA, essentially collecting taxes owed coming out of a partnership audit was very difficult, and it involved potentially chasing down partners way up the chain, right? The partnership's a pass-through entity, so the tax liability is with the partners, and so you got to chase down the partners, and that's administratively hard and potentially impossible. And so what the BBA allowed essentially was to sort of flip that and say the IRS can, as an initial matter, collect those assessments from the partnership itself, even though it's not a taxable entity normally. We can collect from that partnership itself and sort of shift that onus to go chase down partners or to deal with the partners onto the partnership. But the substantive ability to sort of get the return, decipher it, and find the issues and see what's going on is really more what we're focused on here, the stuff that Diana went through above, more so than that procedural side of things, at least for this paper. And I think what it comes down to is the IRS needs to be able to look at a partnership return and understand all those things that Diana was talking about. And I think I've been thinking about that. I think one interesting thing to contrast with my sort of recent life in private practice is that one way to think about this is like, you know, as a tax lawyer, you know, in private practice, when we had sort of a transaction or complicated deal come across our desk, you know, the big thing we always said was, we can't give you good tax advice on this unless we know everything. Like, you can't just send us one snippet of a document and say, does this work? Read this paragraph, does this work? We have to look at the whole agreement. You have to send us a structure chart so we can see the universe we're talking about. We have to understand what people are trying to do as a business matter here. And then we can assess it and say, here are the tax things to think about. Here's how the rules might apply. Here are the gray areas that we should, you know, evaluate. That sort of like understanding of the whole picture to give good tax advice. The IRS's project is sort of the flip side of that, right? They get a return and they don't have any of that. So they're not giving tax advice, but they need to like evaluate that tax advice and those positions taken. And without sort of having that, you know, ability to be like, all right, tell me everything and explain to me in you know, non-technical terms what you're trying to do here. And then I can kind of map it onto the documents. That's sort of the gap that makes things so hard on the audit side. And so I think, you know, the reforms in this area ultimately need to focus more on how to improve, you know, how we can improve existing partnership reporting for the better so that the IRS gets more of that full picture that Diana was going through. And then I will just note about the BBA, because I'm not a technical, you know, I wasn't a controversy person in my practice life. The BBA rules, they, you know, they may help in sort of nuanced or indirect ways that are kind of outside the scope of what we're talking about here. So improving, you know, improving those procedures, I think, is a very good thing at the end of the day. And that may free up IRS resources then to go maybe look at these more substantive issues. That's something more of, I think, a technical BBA expert would need to speak to in terms of like, is it actually doing that? And that may just require more time of living with the BBA to know that. But I just want to sort of note that for completeness. And then, you know, more generally, I do think it's worth noting that we are, I think, seeing some progress in this audit space. So we've had, I mentioned the basis shifting stuff a little bit earlier, and there have been a number of kind of public panels and discussions about that, where we have heard, folks from the IRS say both that, look, this basis shifting stuff is really hard to find on a return, kind of echoing what we're talking about here. It might span multiple years. It might hinge on a decision made 10 years ago that has now developed, and it's hard to find that. But on the flip side, they've also kind of noted publicly that they do have a number of these cases where they've spotted that issue and they're under review and there's a lot of dollars at stake. So I think those are, you can kind of look at those as a positive thing, where it's sort of, hey, this is a hard to find issue, but we have had some success finding it, at least based on what they said. And I think that's a good thing. And then the other just kind of, minor point that I think is worth in this context is that there was, I think, a recent announcement to sort of divide up. One point people have made is that the IRS division of pass-throughs and special industries was pretty wide ranging, right? It handled pass-throughs, but also things as far-flung and potentially unrelated as, the green credits or the low-income housing credit, and how insurance companies are taxed, things like that. And so it's sort of something of a hodgepodge, but there was an announcement to, I think, split that up to some degree so that there's more of a pass-through and partnership-focused division within Chief Counsel. And we'll have to see how that plays out at the end of the day, that division. But I think, at least from here, it's good because it speaks to sort of a commitment to devote a bit more specialization to partnerships, which is something that clearly exists in the private bar. And people have talked about, that's one way the IRS, can, work to catch up a bit. So.
Yeah, I will say I was struck when I was at Treasury. The role of my office was to work with IRS Chief Counsel, or one of the roles, in writing regulations. And it kept being that there'd be, major legislation, huge new projects, and they'd say, well, we're working with PSI. And we're working with PSI. And I was like, does PSI do everything? They just had so many different things under their purview that it made it really challenging for them to focus on the partnership issues specifically. So Diane and Monisha, is there anything you wanted to add, whether on the BBA or information sharing more generally?
I think there is a general need to think about what information we ask taxpayers for. More information doesn't mean better information. More information just means that taxpayers will put something on the form for more information request, and it may or may not be right. Because if taxpayers are overwhelmed, it hurts the quality of reporting. And I think the request for more and more information have created a problem for the profession. Both the private sector and IRS are finding it really hard to attract tax professionals, especially junior tax professionals, and especially partnership professionals. And I think there is frustration on everybody's side that we're filling out these forms that nobody really knows how to fill out right. And, we're fighting over where numbers go and not the substance. And I think there's a way to work together to develop win-win solutions on what's required to be reported. And when we find a problem, to figure out what's behind the problem and what information do we really need to figure out where it exists and who are the, not so great actors, versus just trying to go on a fishing expedition. And I think that requires detailed and deep and continuous conversations.
Yeah, I want to agree with that. I think that the solution to the problems that I was talking about information, are not asking for 10 times as much information on the tax return. And I noted when I was at the IRS that there was a great reluctance on the part of the audit division and Chief Counsel to just ask for more information. I think that's, for all the reasons Monisha said, that doesn't solve the problem. And I also think that one other thing that I noted at the IRS was that when they got certain forms, I would say, you know, how are you deciding based on what's on the form, what to audit? And they didn't have enough knowledge about the information that was coming in to use that information to decide who should be audited and who shouldn't be audited. So I think, you know, this may be one place where AI will actually do some good for humanity, but as we'll see.
Yeah, I think also kind of echoing some of that, one thing that is a potential source of improvement is, you know, not give us more, but it could be in some ways dividing up or how current information is presented and therefore how informative it is. You might have things that are kind of lumped together and impossible to disentangle without further questions, but the same information, if provided differently, might, you know, show you, you know, indicate something or be more helpful in terms of spotting issues. And, you know, I think that echoes some of the stuff we've talked about already in terms of the more substantive side, like how to fix the partnership tax rules. You know, we've talked about the benefits of working within the current framework and acknowledging its benefits. And this is sort of, you know, you could think of as sort of similar to that. Like we have a slew of information. You know, partnership tax returns are super complicated. We didn't prepare them, but I've seen them, and they're huge. And there are a lot of kind of statements and additional information kind of tacked on to the return. A lot of it isn't normalized. And, you know, that could be one source of investigation, is like, you know, is this easier to follow if we normalize some of this stuff and lay out how we want people to do it? And, you know, timely, I don't know that people have really dug into this in a super detailed way, but there was a form released just recently on, you know, partner basis from property distributions. And I think people have made the note that, well, a lot of this was, you know, a lot of this information was in the K1 or in statements to the K1. So maybe this isn't necessarily like a huge new thing they're requiring from people, but it's now on its own form and laid out in a way that may be easier for the IRS to follow and calculate. And, you know, we'll see how beneficial that is, but that might be the sort of thing that, you know, bears fruit in terms of improving reporting rather than, hey, give us more. So.
And a lot of the more reporting has to do with changes outside of subchapter K and different new laws and how they interact, and the fact that, you know, there isn't detailed guidance or a detailed understanding by anybody of how various new regimes interact with the partnership rules. So it's not really a problem with subchapter K itself. It's a problem with, you know, having different parts of the code not talk to each other too well. And I think, like, for example, the corporate alternative minimum tax, we have 604 pages of new regs, and that's going to increase the thickness of any partnership tax return if there's an applicable corporation that, you know, somewhere up top. I think that results in frustration for everybody, since nobody really knows. I just think this is an area for win-win solutions if we all work together.
So it strikes me that maybe going back to the VBA, there's like at least 4 ways to improve partnership taxation. One is clarify the law, so you can't just shift from one pocket to another between different entities. Another is information reporting. So you're not just looking at one dot on the spider web, but you can see more of the spider web. The IRS can, just like the taxpayer can. Maybe another is to be able to use that information more effectively within the IRS. And this may go to the long-term investment in the IRS, that they're finally going to be able to really improve their IT systems, hopefully to match the partnership return data to the partner return data, not have hiring freezes so they can build up the expertise and train people in partnership law and more of them, And then the last one is when you've actually audited and found money that is owed, being able to collect them. And BBA dealt with that last piece. But Bill, I'm curious on the information reporting. What do we know about the importance of information reporting in terms of the tax gap and whether people pay taxes that they owe?
In other contexts, information reporting makes a huge difference. So wage income, for example, which is reported by the employer to government, has a very low evasion rate, except ironically for tips, which is the areas being discussed for tax cuts. There's both third-party withholding from wages, third-party reporting and withholding, and that combination is very strong. If you just go down to information reporting but don't have the withholding, then the evasion rates are higher in the order of 15%, which is around what the official partnership evasion rate is reported at from the IRS. But I think everybody understands that it's potentially missing a lot of evasion. And then in situations where there's no third-party reporting and no withholding, evasion rates are quite high, on the order of 50% or higher. The farm sector and sole proprietorships are the prime examples here. So in other contexts, information reporting can help a lot. Given what Diana mentioned earlier, I think it would probably move in the right direction, but I'm not sure it would be the kind of the panacea that it is in other contexts.
Yeah, it sounds like it needs to be smart information reporting and by being able to match data. So right now, you don't even know about the other entities, and just adding more information reported by the one dot would be less helpful than allowing the IRS to see more of the big picture and interconnections.
That's basically the concern that I had. Yeah.
Yeah.
They're also
Miles.
they're also intertwined, right? Like how well and how easy to follow and how whatever ungray, whatever the substantive rules are, there's only so much that you can do with information increasing or improving information reporting on the partnership return. The IRS still needs to decipher and understand the return. We can make that easier or harder, but at a high level, the better the rules are on the far front end, the more informative those returns will be in whatever information reporting framework we have, I think. And so, where there are things like a lot of gray areas where it's like people are gonna, find ways to play with them, that may not be apparent on a return. But if there are fewer of those, and this is the struggle of writing good rules, I think that will kind of flow through to the return as well. So they are, I think the substance and the information report and the audit ability or the information reporting are really intertwined.
Yeah.
I think one clear example there is like, what other pieces of paper do you need to determine if a calculation or allocation has been done right? And I think many of the partnership tax rules make sense theoretically, because you're trying to get to what is economic under at least one view of the rule. And then you have other, but you need to have basically pieces of contractual documents between partners and partnerships to apply these rules. Rules with respect to data allocations fit in this bucket. You can argue that they, reflect one theory of how the world might operate. Maybe it's not, it's just one, probably not the only one, to say the least. But then you need to have the guarantees or the loan agreements to just figure out how to apply the rules. And I think, it's a tension between like, this might make sense or this might have made sense. But wait, nobody's going to have the box of loan agreements and guarantees while they're looking at the tax return, either to do it or to audit it.
Yeah. So Manisha, I wanted to turn back to the proposals themselves and something, I can't remember if it was you or Miles who said it, but that a lot of these proposals have a history. And I'm struck that having worked on the Hill, often it takes, 10 years for something to pass. And it really needs both, you need to have the language drafted, as you said earlier, and it needs to sort of gestate and members to get comfortable with, okay, yeah, I've heard of that proposal. Yeah, that I got briefed on that. That makes sense. So could you give a bit of a sense of whether some of these proposals are similar to reforms that have been advanced in the past and what their motivation is?
So I think many of the current proposals first are not that dissimilar to some of the proposals and choices considered in the 1950s. There's a American Law Institute report from the mid-50s, and if you go read it, it is fascinating or eerily similar to some of the reform ideas we see today. And they had obviously were looked a little different then, but it's still fascinating to see what choices they put forth and why they did. And some of those are actually on the table right now. In terms of more recent history, many of the proposals that Miles discussed, are in multiple legislative drafts. Many of the proposals are both in Camp and Wyden, and the Wyden passed through discussion draft, and others are in Build Back Better. And when members of Congress start with like thinking about an idea, they don't start with a blank piece of paper. You were on Senate Finance Committee staff. You don't go like, I'm going to start with nothing. I'm not going to read anything. You pull from what's out there, and tax staffers on the Hill are definitely going to look to see what's in Camp, what's in the Wyden pass-through discussion draft, and what's in Build Back Better, and what else is out there. And so taxpayers and tax advisors should, look at members' websites, look at congress.gov to see what's out there and offer suggestions to help improve what's out there and to talk about policy concerns, technical concerns. And I do think that's a really good discussion for everybody to have as we get closer to 25. And just because I think this was one of your questions, I do think it's worth highlighting some of the proposals that are in both Camp and Wyden, just because they're two places to grab the same thing from. So the changes to the so-called mixing bowl rules, that's when a property goes into a partnership, it goes out to another partner, or cash goes back to contributing partner. The changes to those rules are in both Camp and Wyden. There's special rules for retiring partner in the tax code right now. Those changes to those rules will actually just the repeal are in both Camp and Wyden. And there are certain rules for ordinary assets held by partnerships, and changes to those rules are both in Camp and Wyden, as are changes to the rules for so-called guaranteed payments.
It's really helpful. And, just as a reminder for those tuning in, Camp and Wyden is shorthand for bipartisan. So a lot of these proposals have bipartisan backing historically. So I know that we're nearing the end of time. Maybe bringing it back to the beginning, Bill, is there anything you would sort of remind us of why it's important for us to be thinking about partnership tax and these reforms at this moment?
We've definitely gotten into some details here, but as you say, it's important to keep your eye on the big picture, and that's basically revenues. There's potentially a lot of revenues being lost, distributional effects. There's potentially a lot of after-tax income being shifted to the very highest end of the income distribution by an antiquated set of laws. And then third, and I might say on the other hand, there's the incentive effects of taxes and the need to be able to accommodate the complexities of different types of partnerships. So I mean, this is just a classic case of tax policy trying to weigh different objectives against each other. And the one thing I think we're all certain of is that the law needs to be updated. There's a lot of ways to do it, balancing these different objectives, and that's what policymakers will have to focus on.
Thank you, Bill. Well, And thank you all of our panelists today. This has been a really fascinating discussion. Thank you, Miles and co-authors, for a great paper that taught me a lot about how to balance those objectives, and that there really are achievable, bipartisan, well thought through reforms that raise a lot of revenue from the very wealthy in this space. And thank you everybody for joining us today.